Good day, welcome to the latest news update on Canary News. Two prominent Wall Street firms are advising investors to consider buying 5-year U.S. notes following their most significant decline since May last week. Morgan Stanley anticipates a potential rebound in Treasuries, citing expectations that upcoming data may surprise on the downside. J.P. Morgan Chase recommends investing in 5-year notes as yields have risen to levels last observed in December. However, the firm cautions that markets may be overly aggressive in pricing for an early initiation of central bank interest rate cuts. Morgan Stanley views the recent dip as an opportune buying moment, highlighting potential downside risks to U.S. activity data in February amid reduced fiscal support and colder weather. Last week, 5-year U.S. yields experienced their most substantial increase since May 19, as traders reduced bets on Federal Reserve interest rate cuts this year. Central bank officials' pushback and positive retail sales data caused the odds of a March reduction to plummet to nearly 40%. The market now expects 5 quarter-point cuts from the Fed this year, down from the 6 to 7 reductions anticipated on January 12. While long-term treasuries saw modest gains on Monday, the bond market faces potential upward pressure on yields with upcoming Treasury debt auctions. Concerns persist among investors that the Fed may not pivot or has accumulated too many bonds. The bond market also confronts risks with the release of the first reading of U.S. fourth-quarter GDP and the Fed's preferred gauge of underlying inflation later in the week. Analysts anticipate reinforcing the potential for a soft landing, enabling interest rate cuts this year. However, uncertainties surround the timing and pace of an easing cycle, impacting Treasury market dynamics. J.P. Morgan expects the first Fed cut to occur in June, contrary to the fully priced-in May move by swaps contracts. Morgan Stanley foresees central banks in the U.S. and Europe coming into focus in mid-March, projecting markets to price in at least one rate cut by early spring for most central banks. In other news, the sell-off in Chinese stocks in Hong Kong escalated today, driving the discount to mainland counterparts to the widest margin in 15 years. The Hang Seng China Enterprises Index dropped 2.4%, nearing a level not seen in nearly 2 decades. Meanwhile, the onshore CSI 300 index finished 1.6% lower, leading to the broadest price gap between mainland stocks and their dual listings in Hong Kong since 2009. This suggests a 36% discount for the offshore market. The increased losses in Hong Kong, home to influential and innovative Chinese firms, present a concerning outlook for global investor sentiment toward the world's second-largest economy. Despite a positive Wall Street performance, with the S&P 500 reaching a record on Friday, signs of government intervention to support the mainland market have grown. Various factors contribute to the prolonged Chinese stock sell-off, including a housing market decline, persistent deflationary pressures, and uncertainties about U.S. interest rate trends. The decision by Chinese commercial lenders to maintain benchmark lending rates, following the central bank's similar choice to keep borrowing costs unchanged, may have disappointed investors anticipating more aggressive stimulus. Redmond Wong, a market strategist at Saxo Capital Markets HK Ltd., notes that many overseas institutional funds have reallocated from Hong Kong to other Asian markets in their Asian allocation. Chinese stocks listed in Hong Kong are considered a more accurate gauge of the broader investor sentiment and the health of the second-largest economy, while trading in Shanghai and Shenzhen is often influenced by Chinese regulators. The HSCEI was slightly over 1% away from reaching its lowest point since 2005, and Hong Kong's Hang Seng Index approached a level not seen since 2009. Major contributors to Monday's decline included tech giants Meituan and Tencent Holdings, along with electric vehicle makers Li Auto and BYD. The sell-off may result from a lack of near-term catalysts and outflows to more attractive alternatives in the region, according to Marvin Chen, a Bloomberg intelligence analyst. In mainland China, the CSI 300 hit a new 5-year low, and the increased turnover on exchange-traded funds tracking key indexes indicates potential state-led buying to limit declines. The sell-off is also impacting snowball derivatives, with the CSI Small-Cap 500 index slipping 4.7%, potentially triggering widespread losses on these structured products. In less than a month into the new year, the gauge of Chinese stocks listed in Hong Kong has already experienced a 13% loss, making it the worst-performing major benchmark among global indexes. In contrast, the S&P 500 has gained 1.5%. That's all the time we have for today. Remember to share the video, smash the like button and subscribe to our channel. Tune in tomorrow for the latest news update on Canary News.